I'm Troy Sainsbury, a mortgage planner in Madison, Wisconsin. And in this comparison, we're looking at the example of renting an apartment versus owning your own home. And in this example, if we take a client who is currently renting for $900 per month and compare that with buying a home for $175,000, we can see that the net monthly payment is about the same. Now, there are some assumptions that we make in this comparison. We first assume that the rent's not going to increase every year. It's not likely, but it puts this comparison more in favor of renting. The long-term appreciation rate for residential real estate in the United States is between 3 and 4%. Conservatively, we use about 3%. Property is going up in value. Over the years of 07, 08, 09, well, we haven't seen this kind of appreciation. In fact, in a lot of areas it's pretty flat, or maybe depreciating a little. The years leading up to that were considerably higher, but again, long term, we'd expect somewhere between 3 and 4%. And for this comparison, we're going to use a 3% appreciation rate. Use a 30% tax bracket, meaning this person's paying an average 25% federal income tax rate and 5% state income tax rate, so they're paying about 30% of their income in taxes. With a purchase price of $175,000 and interest rate on their new mortgage of 6%, we have a first-time homebuyer program with 3.5% down, would require about $6,125 of down payment. This homebuyer program also has a closing cost of $2,955, but that can also be added on to the loan. So it's not money they have to bring to closing, and their cash to closing would be the 3.5% down, or $6,125. Comparing these two scenarios side by side, we look at the total rent of $900 a month over 3 years being about $32,400. There are no tax benefits to renting and no real estate that's appreciating, so we can see that the total outlay here is still $32,400. For the person who's owning their home, their total monthly payments would be a little over $51,000. A significant portion of that, though, is principal that they're paying down in their loan of $6,700. They also have some big tax benefits of about $13,000. So their net cost into owning a home is $31,700, just about the same as renting. The big difference here is that their real estate will have gone up in value, and they will have paid down some of that loan. So we can see they're about $26,000 ahead after 3 years. Stretch this out over 5 years or 60 months, and we can see that the home ownership is going to accumulate almost $43,000. The difference between the real estate value and the loan balance. And we look at the total cost into both the home ownership and the renting, just about the same. If instead of putting the $6,125 of down payment, just to compare apples to apples, we assume that the renter is going to be able to take that $6,100 and invest it. We use an 8% investment return that they're going to get. A little bit aggressive, but again, just more in favor of renting. And we can see that after 3 years and after 5 years, they are looking at an investment account that's accumulated over $9,000. The homeowner, on the other hand, has accumulated nearly $43,000. And the net difference then after 5 years, the homeowner is nearly $34,000 wealthier.